Hello, Professor. I'm Fan Jiaqi. The topic of our group assignment is analysis of the annual report of BrightTech. The company operates a hybrid three-pronged business model. The core segment is environmental service, which acts as a financial anchor, generating 79% of total revenue. This provides stable recurring income driven by strict regulations. The other segments, system, equipment, and investment, serve as cyclical drivers and asset safety nets. 2023 was challenging, with revenue dropping slightly by 2%. In response, management adopted a defensive stance. Instead of aggressive expansion, they operated efficiency and cost control to protect. However, the company faces key risks, primarily the dependence on a small group of technical experts and competitive pricing process during tender processes. In conclusion, BrightTech is a major defensive firm. Its combination of recurring service income and real asset holdings makes it highly resilient against economic uncertainty. Thank you.
Hello, Professor. I'm Li Yan. Today I will talk about BrightTech behind in 2023. I found the main problem. The core business is weak, but they are very active in buying assets. First, let's look at profit. We see a negative scissors difference. The company saved money on production costs, but administrative expenses went up by 15.6%. So the savings are gone, the efficiency is low. Also, the profit quality is not good. 19.21% of the profit comes from property prices going up. It's not from real business cash. Next, the balance sheet. The strategy has changed. Look at the PPE. It went down by 1.41%. They didn't buy new machines. But look at investment properties. It went up by 17.77%. They are buying houses to collect rent. And how did they pay? They borrowed money. Total debt went up by 27.83%. Debt is growing much faster than equity. This is risky. Finally, cash flow. The investing cash flow is positive. This is very strange for a growing company. And why? Because they sold assets for 2.06 million ringgit. Without this sale, they would lose money here. In conclusion, the report looks stable, but it's not. High debt and weak operations are the real problems. That's all. Thank you for your listen.
Hi everyone, I'm QU. I'll briefly explain the financial structure of BrightTech in 2023. Let's start with the income statement. BrightTech shows a very high gross margin of 59%, which looks impressive at first. However, administrative expenses take up 26% of revenue, and about 30% of revenue comes from other operating income, not core operations. This means the gap between operating profit and net profit is driven mainly by no core income. So the 29% net profit margin should be treated with caution. Looking at the balance sheet, the structure becomes clear. Investment properties make up 66% of total assets, nearly 100 million ringgit. Even though the company holds about 20 million ringgit in cash and liquid assets, Most capital is tied up in property rather than operations. This shows BritTech is asset-heavy and not a high turnover manufacturing business. Putting this together, BritTech shows a clear structural duality. Operationally, it looks like a water-related business, but financially it behaves like a property-backed hybrid entity. This explains high mergers but slow growth, and it's important for understanding the company's ROE. Thank you.
Hello, Professor. My name is Gu Yuma, and my metric number is 3410135. I will present to you the first three parts of Chapter 4. Ratio analysis. Part 1. Liquidity analysis. We teach maintaining a highly defensive balance sheet. In 2023, the equity ratio increased to 3.89 up from 3.86 in 2022, with a quick ratio of 3.77. The company proves it has immediate high-quality debit ability without relying on inventory. This conservative strategy ensures assets are sufficient to cover short-term obligations for nearly 4 years, even amid macroeconomic uncertainty. Part 2. Operational efficiency. However, operational efficiency faces pressure. The cash conversion cycle extends to 85.7 days due to industrial slowdowns. We see a significant working capital gap. The company pays suppliers in 29.4 days but waits 86.9 days to collect from customers. Essentially, management uses its massive cash reserves as a lubricant to maintain key relationships through lenient payment terms. Part 3. Asset quality and strategy. Regarding asset quality, 33% of accounts receivable are overdue for more than 60 days. Impairment pressures remains low at 4.3%, as management trusts the credibility of these long-term customers. Inclusion. British strategy is trading for space. They accept the opportunity cost of trade up for the secure market share and making a cautious defense stance. That's all. Thank you for your listening. Then ask my partner to talk about the remaining two parts of Chapter 4.
Hello, Professor. My name is Su Qihao. Okay, first is profitability. One thing to note from the annual report is that ROA and ROE use average assets and equity, so it's not distorted by year-end numbers. In fiscal year 2023, revenue depleted slightly, but gross profits actually went up. So GPM improved to 59%, but even though NPM is still very high at 28.8%, we can't just accept it at face value. We need to check the profit quality. Not for profit quality. A big part of fiscal year 2023 profits includes a non-cash fair value gain from investment properties. World One ponies its mailing regent. After removing this and adjusting for tax, core profits after tax falls to around RM5, ponies 18.5 million, and core NPM drops to about 23.3%. Using DuPont's analysis, we see high margin but low asset turnover, which explains why ROA stay around 5.2%. Okay, moving on to solvency and leverage. Debt here refers to total loans and borrowings. The debt to equity ratio increased from 0.14 to 0.154, showing greater reliance on external financing. At the same time, interest coverage fell from 8.31 times to 5.52 times. The company is still solvent, but higher leverage and lower coverage means reduced financial flexibility.
Hello, Professor. My name is Huang Zimeng. My match number is 2410175. Today I will present our review of the Part 6, Financial Report Integration and Comprehensive Review. First, let's look at the picture. 2023 was tough. Malaysia's GDP growth dropped sharply to 3.7%. Despite this, BrightTech survived by focusing on one thing, efficiency. But cutting costs ridiculously, they managed to increase their cost margin to 59%. This was key to staying profitable in a weak economy. Next, we analyze their return on equity, which was 8.46%. Here is the breakdown. Profit margin is high, over 28%. Their technology allows them to maintain good prices. Asset turnover seems low. This because they hold a lot of real estate for stability. Leverage is low. They have very little debt and prefer to play it safe. This stability comes from their two-wheel driver model. BrightTech isn't just an engineer company. They are also property investors. Their assets generate about Rm 2.34 million in rent every year. This rental income acts as a safety valve. Even the water business slows down, the cash keep flowing. In conclusion, BrightTech is a defensive powerhouse, but for the future, they need to change. They are sitting on a cash reserve of Rm 13.24 million. Our recommendation is simple: start spending strategically. They should reinvest the cash into R&D or new services to boost growth. Thank you.
Hello, Professor. My name is Yuan. My topic is strategic proposal for the next 5 years, which mainly involves analyzing and providing suggestions for the company's development. In 2023, the growth of Malaysian GDP slowed down, but our company showed greater toughness. Our revenue just dropped a little bit and did better than the industry average. By controlling costs strictly, we managed to raise our gross margin from 55.2% to 59%. This shows we can stand up to pressure. Our growth strategy is changing from playing it safe to growing with cash. We'll boost our business from within using a tech-based asset and make a smart buys. Also, we'll make our asset structure better and get a stronger foothold in the market through integration to save cost. When it comes to managing money and risk, we want to make our return on equity better by optimizing dividends and using leverage wisely. For risk management, we pay attention to cost control and managing working capital. For instance, we talk with suppliers to fix costs and borrow in automatic systems to deal with uncertainties.